Good morning, everyone. This is Marshall Gidler bringing you the morning comment for January 9th. According to Bloomberg, Eurodollar finished its first trading day in 1999 at 118.21. This morning, we're opening in Europe around 118.07, back to where we started from. Are we now headed back to the low of 0.8255 on 25 October 2000? At that time, the gap between the Fed funds and the refi rate was 175 basis points. That's easily achievable. The 3-month Eurodollar and Euribor futures are telling us that the spread will be around 200 basis points in 3 years. Looking at yesterday's European news, German factory orders and Eurozone producer prices both falling more than expected in November, it looks to me like the ECB will have to make up for lost time. Unfortunately, the ECB board appears to be still divided and might need more time to make up its mind. Yesterday, ECB President Draghi and ECB board member Kur came out with quite different comments on whether it was time to start doing quantitative easing. So despite Draghi's claim that the board's unanimous, it still seems to me that there's a disagreement. I think we have to consider what the market reaction might be if they can't agree to start quantitative easing at next week's meeting. I believe it could cause a huge sell-off in Eurozone bonds and equities and a repatriation of capital, causing the euro to weaken further. China's producer price index fell 3.3% year-on-year in December, a substantially faster rate of deflation than in the previous month. It seems to me only a matter of time before falling PPI feeds into falling CPI, and Chinese deflation begins to affect other countries as well. That's likely to keep interest rates low around the world and help to fuel the currency wars that result from the spillover of domestic monetary policy into the international arena. The highlight of the day today is going to be the U.S. non-farm payrolls for December. The forecast is for an increase in payrolls of 240,000. That's down from the extraordinarily high 321,000 in November. But despite the slowdown, expectations of a slowdown, it'll still show that the U.S. economy has added at least 200,000 jobs for 11 consecutive months and could result in the biggest annual gain in employment since 1999. At the same time, the unemployment rates forecast to have declined to 5.7% from 5.8%, while average hour earnings are expected to accelerate on a year-on-year basis. Such a strong employment report is consistent with a firming labor market and could add to the strength of the dollar. We've also got wholesale inventories for November coming out. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Gidler, Head of Global FX Strategy at IronFX Global, wishing you solid trading.